Hello and welcome to the Solutions Scoop. I'm Ravi Venkatraman.
And I'm Amanda Tepper. Ravi and I are co-founders of the Chestnut Solutions Institute, an independent forum dedicated to advancing the future of the investment solutions industry. Here at The Scoop, we examine the latest solutions marketplace developments and speak directly with solutions industry leaders. Our guests span the investment ecosystem, from OCIOs to asset owners, investment consultants, asset managers, and other key industry stakeholders.
These conversations are an important part of the Institute's mission to improve transparency and help establish standards and best practices across the solutions industry by educating asset owners, providers, and all other industry stakeholders. Let's get to today's scoop.
Good morning, everyone. I'm Michelle Brown, Executive Director of the Chestnut Solutions Institute, and I'm very pleased to welcome you to this webinar focused on nonprofit investors and investment solutions. We launched the Institute almost a year ago, and we've been very pleased with the market's response. Our mission is threefold: to educate the marketplace on the OCIO and solutions industry, and this event today, as well as the report we published last month called Defining Investment Solutions, are examples of our activation on educating the marketplace. And it's important to note that all of the charts and data that we refer to today were taken from that Defining Investment Solutions report. The second aspect of our mission is to communicate standards, and our panelists, both the allocators and the providers, will speak about the best practices they consider in the course of building their businesses. And finally, promoting a level playing field by enhancing transparency is another key mission of the Institute. And in just a few minutes, you'll hear a lot about the need for transparency in the solutions industry and how our panelists are each working to improve industry transparency. How does CSI activate its mission? We create proprietary research and thought leadership, and we curate peer forums where leaders of OCIOs and solutions businesses can convene to discuss the most pressing agenda items for the industry today. And we also provide visibility for our members through events like these. So I just want to welcome all of our panelists, each of whom focuses on the North American nonprofit space, so endowments and foundations. Our allocators include Mark Brovak, who is the VP and CFO of the Foundation for Western Washington University. Teresa Rodgers is the Executive Director of the Presser Foundation. And our investment solutions providers and CSI members are from Bank of America, Bernie Reidy, Managing Director and National Nonprofits Executive, and State Street Global Advisors, Zach Serhant, VP and Head of Solutions Distribution. And last but not least is our moderator, Jane Bobyock, an advisor to CSI who's contributed substantially to our Defining Investment Solutions report, a seasoned industry professional with over 30 years of experience working in institutional asset management and nearly 20 years at several leading OCIOs and investment solution firms, always focused on nonprofit clients. So this conversation couldn't be in better hands than with MJ. And with that brief introduction, I'll turn the conversation over to you.
Thanks, Michelle. Hi, everyone. The Institute, as you've heard, has done a lot of research on the OCIO marketplace, and that includes its definition of investment solutions. So it's defined as all solutions and products, services, where the primary goal is to meet a specific need of a unique investor or set of investors. So today we're specifically talking about nonprofits. We're going to focus on the growth of the OCIO marketplace in the U.S. And you can see that back in 2016, we saw about $870 billion with a B in U.S. OCIO marketplace. By 2023, that more than doubled to $1.8 trillion. And Chestnut is projecting future growth to come in near double-digit levels, around $3 trillion in the next 5 years. We're going to talk a little bit more about the Defining Investment Solutions report, where we surveyed both investment consultants with OCIO capabilities as well as asset managers with OCIO capabilities. When we asked them what market segments they expect to see the highest growth rates in, and across the board, endowments and foundations were by far the number one response. Historically, smaller organizations really benefited, but even now, mid and larger size organizations are joining the OCIO trend. What makes the OCIO structure so appealing for so many different size cohorts as well as types of nonprofits? And why do we think nonprofit organizations are growing at almost 3 times the rate of other market segments? I'm going to turn it over first to Mark and then Teresa, but please give us a few more details about the background of both of your organizations. Mark?
Thanks, MJ. Appreciate that. And the foundation for Western Washington University is an institutionally related foundation that is created by Western Washington University. And we serve specifically the needs of that university. And so we have a number of things that we work with and deal with because of our relationship with the university, but we are independently governed. And so we still have an independent board and we make investment decisions independently as well from the university. We're a mid-range regional in the state of Washington, about 16,000 students, and we've been in existence for 125 years. So we have a long legacy serving the citizens of the state. We've been an OCIO client for a number of years, in fact, all the time I've been here. And it really, to us, boils down to, I would say, discipline, access, and truly efficiency. We have a moderately sized endowment, about $140 million. And we have found that our committee, finance committee, we don't have a specific standalone investment committee, and our finance committee wears lots of hats and does a lot of things. And so the idea of that committee really being responsible for the manager selection and things like that is just beyond probably what they'd have the desire to work on and do. And so the OCIO model really works well for us. Number one, it maintains discipline. We stay within the IPS. We've got this partner that's on the same side of the table that really helps make sure that we don't veer off or go with the latest idea, latest trend. We feel like we get a lot more access to managers that we probably at our size would never really have the capacity to be able to reach out to. And for what we pay a fee, we feel like there's an efficiency and really a time savings in a lot of ways from what we're able to get from that relationship. And all in, those are, I think, a few things that really find valuable to us at Western.
Thanks, Mark. That really allows for a much more strategic discussion, I'm sure, at the Investment and Finance Committee meetings. Teresa, can you tell us a little bit more about the Presser Foundation and your thoughts about the growth in the OCIO space?
Sure. So the Presser Foundation is about a 100-year-old private foundation that is focused on what our benefactor, Theodore Presser, calls musical philanthropy. And the Presser Foundation does have a very long history of doing it yourself finance committee. At one point, the private foundation owned a publishing business and owned a home for retired music teachers. It owned an individual bond portfolio, so very complex. And over the past several years, our finance committee has taken steps to simplify what we're doing. So selling off the publishing business, selling the home for retired music teachers. And today, our investment portfolio has been simplified into various mutual funds across equity and fixed income, all managed by our finance committee from an asset allocation perspective. But when I think about the question that was just asked and what is driving at least our peers in the space to move towards OCIO, I really do think it's related to efforts to center equity within the private foundation space. And you cannot go to a private foundation conference or a philanthropic conference without talking about mission-aligned investing. So I do think those two things are causing our foundation peers and the Presser Foundation to rethink traditional models of managing portfolios. And I think that's what is really driving the growth within the endowment and foundation space.
That's important, especially in the private foundation space, as you mentioned, of having so much synergy between mission and the implementation of the investment portfolio. Bernie, any follow-up thoughts from your experience?
Yeah, and I'd just give you a quick overview, MJ, just on the business for folks here.
Please, yeah.
So we're in the OCIO business, obviously, is one of the providers. In fact, we're listed by P&I as being the largest OCIO for endowments and foundation here solely in the U.S. is where we focus. We've got about $91 billion in assets, nonprofit assets, about 1,200 clients. And we have a dedicated practice and group within Bank of America that's focused on this space, working solely with endowments and foundations. We have about 180 people across 40 markets. So we work locally and bring our resources to serve the nonprofits in each of the communities of those 40 markets. We also have a unique consulting practice built within that's focused on nonprofit business consulting for our clients that we wrap around as an additional service to our clients. But I think as we look back, and I've got over about 20 years of experience specifically working within the space in the OCIO industry, rapidly evolved, obviously, over the last, since the financial crisis. And really what I've seen as the growth there is stemming from what I feel is, I refer to it as the governance budget. And I think most organizations think about budgeting when it comes to finance, maybe risk budgeting when it comes to investing. I don't think most folks would think that they have a governance budget, but they do. And it will fluctuate over time. And when I think about governance budgeting, it really comes down to your resources and time. So when you look at your board and the trustees and your investment committee members, what's their experience? What's their expertise? How much time do they have available? You might find some that are able to meet twice a month in a very active committee. Others, maybe it's 4 times a year. If in a traditional consultant model, that's typically what they'll be doing. But how effective are they at making decisions and being able to make timely decisions? Sometimes you can have the who's who sitting around the table from Wall Street, but they're not very good at making decisions. Everyone wants to kind of speak and they might defer into the next quarterly meeting they get together. So governance budget is simple to think through. Okay, how many resources? What's our time available? What could we do? How are we able to handle it? And when you balance, you figure out where you're going to spend your time. Most organizations realize today, studies are out there to show over 90% of your return is coming from your strategy, the strategic asset allocation. Committees are finding with the complexities of their portfolios today, they need help on the implementation. They need help with the rebalancing, the hiring and firing. Their time spent, depending on their governance budget, should be focused on what's most important. Is it most important to figure out what's the right small cap manager that you should be adding to the portfolio, or should you really thinking about the strategic needs of your organization, your liquidity and cash needs that you might need, and then figuring out what's the right strategy, and then having a partner that can help execute and implement. And I think that's really where the growth is coming from. Folks realize they don't have that governance budget to be able to effectively do it themselves with the complexities of portfolios.
Yeah, Mark mentioned too about the efficiency, and we're really talking here about the efficiency of the implementation. I know in our prep call, we talked a little bit about some of the research we've seen on building it internally for those larger organizations. And that fee number comes in roughly 150, 200 basis points, I think we saw. So the decision to externalize your CIO capabilities is adding to the growth of this marketplace. Jack, I'd love to hear your thoughts. Tell us a little bit about your background.
Yep, thanks, MJ. So Jack Serhant, I'm responsible for distribution for our OCIO practice at State Street Global Advisors. We manage roughly $150 billion in total for OCIO clients. About $24 billion of that is for nonprofit organizations. And that spans various client types, being endowments, foundations, in addition to plan giving assets, so charitable gift annuities, trusts, pooled income funds, as well as some retirement clients as well. So we've been in the space for about 30 years and have deep knowledge across the board as it relates to a lot of the nonprofit type clients that we see. For the question at hand and OCIO and it rapidly growing over the past X number of years, everybody's made great points. The ability to gain access by having large organizations, having access to different managers is a great point. Cost savings, as MJ referred to the fact that building a team internally, there's a heavy cost there, whereas you can take advantage of those economies of scale externally. And that being said, an OCIO, it really is a partnership for your organization. So even though they may not be sitting next to you in the office, it should still be viewed as somebody who is a part of your team, a part of your staff. So it's like having that internal CIO and staff in-house. But what I would harp on, and one of the reasons why it's grown so tremendously over the past few years, is OCIO used to be a scary term for a lot of folks because a lot of organizations thought that meant you had to turn over the keys and that the OCIO ran the portfolio in its entirety and there wasn't much input at all from that of the committee or the organization itself. But that's changed quite a bit over the past X number of years, where a lot of OCIOs have become much more flexible. So there's the ability to have full discretion over a mandate, the ability to hire, fire, set strategy, so on and so forth. But you can also now take a lot more of that decision-making in-house and have the ability to have an OCIO implement, which is very important when you think about being in the markets, being timely, being efficient. So I think that's one of the biggest factors that we've seen, is the ability for us and others to be flexible, and that opening the door to a lot of organizations, both smaller and larger.
MJ, I was just going to say, Jack, I think you make a really good point, which is that flexibility has evolved. You're absolutely right. And you're seeing more of that. I think that's what's appealing to the mid to larger end of this of size clients that are looking for a little bit more of that flexibility. You might have some organizations that have tried to do it with their own internal staff and have struggled to do it just based on the limited resources and budget they have for it. And so if you can be that complementary provider that can come in and build around and be that extension of their team, that flexibility has come in over the last, call it 10, 15 years, where now the larger organizations, for a while, it was most of the organizations out there would say, oh, that's for smaller nonprofits. That's not for us. But that flexibility, more services coming in, I think the larger end of the market is starting to look at that flexibility as an option now for them as well, which I think is fueling the growth. So that was a really good point, Jack.
Yeah, some of the surveys I've seen is that I've actually earmarked the 500 and above size cohort as the fastest growing adopting the OCIOs because historically we've had such a high adoption rate from the smaller ones. That leads us perfectly into our next slide, which really describes the part of the framework that Chestnut has developed for the solutions industry. And this is described more in the report in more detail. But as the OCIO industries evolve, like we've been talking about, there are a lot more, a number of different types of providers, each with distinguishing types of competencies. Two of our panels today represent the asset manager in the banking industry. I've worked at both OCIO specialists and at a OCIO consultant firm. So we bring a lot of different historical experience from that perspective. In this survey, we looked at capabilities like market segment expertise, manager research, trading, risk, custody, scale, all of these as universally being used across the industry, but maybe some types of providers have advantages to some of those capabilities over others. Teresa, let's start with you. What characteristics of a nonprofit organization align best with these different types of providers in your experience?
And maybe I'll start with the Presser Foundation and then reference my peers. So within the Presser Foundation, we're in the middle of strategic planning. We started efforts to center equity within our organization, starting with our grant making and our operations. And now we're just starting to think about it within our investment portfolio. And it's really that challenge that we have as volunteers sitting on a finance committee and staff with limited investment management experience, trying to figure out how to center equity at the same time within an investment portfolio. And then how do we better align our assets towards our mission? And it's that expertise that I think we're seeking as we rethink how we're doing things. And so I feel like for organizations similar to the Presser Foundation at that kind of stage or cycle in our maturity, that we're really looking for that consultant or specialist to really help us with these specific issues. And I'm seeing a lot of that amongst our peers as well. And especially if they're making changes, maybe they've worked with an asset manager for a really long time, but they want to know who their portfolio managers are. They want to know what is the diversity of the portfolio management teams. They want to know what they're invested in. And so I've seen a lot of peers transition maybe from an asset manager to a CIO specialist in that regard.
Yeah, the DEI information has been much more transparent over the past few years, as we all know. I think in the private foundation space, it's even more specific because of the alignment with a very specific mission. And I can see why an expertise in that area would be a driving force for the type of provider that you would select. Most of these providers do have some experience across the board in responsible investing, DEI implementation, or factual numbers. But I would agree with you that some, because of the specific nuances in private foundations that are looking for example, with Presser, you're trying to find the intersection in an impact space of music education in Philadelphia. That's a very niche kind of goal. And so you really do need someone who understands the local space. Mark, any thoughts from you?
Yeah, I echo a lot of what Teresa said. We are little different in that now we're a foundation that manages what might be considered a public portfolio, or at least it's related to a state institutions. We have a lot of constituencies that we have to answer to. It's not just donors, it's students, it's faculty, and everybody has an interest in what is in that portfolio in a lot of ways. And even just right now, many of you are watching the news, you know that there's a lot of emphasis and focus on portfolios of universities. That's one thing. Secondary, from the nonprofit standpoint, most of these nonprofits are managed or overseen or governed by volunteers. And so they're not paid, and they're not necessarily, again, to that point of what's your governance budget. In a lot of ways, the budget is low or light. And from that standpoint, oftentimes, I think those OCIO specialists or generalist options for us are great. And I think the other thing that's important to reflect on is that the investment space is complicated, and it's gotten more complicated and more broad, and just the number of OCIO providers out there has just mushroomed over the last, say, 10 years. And finding the right one is one thing. But secondarily, it's boiling it down to something that's curated that I think really helps these committees, my committee especially. If we had 1,000 options, I don't know where we would start. But because we've got a dozen options, and these again feel curated, and they're the best of what our provider can find and be involved with, gives us comfort. It gives us a sense of, okay, we're in good hands. We're doing the right stuff. We've got a great partner on our side of the table. And I think that gives just a significant amount of peace of mind for us in that regard. I think nonprofits just are in a special spot, and that person on that side of the table makes a big difference.
Yeah, and I know we talked a little bit too about the role of a co-fiduciary also adding to that peace of mind. And that's an important aspect that you don't often get with some of the more traditional investment implementations. I think we're going to go next to Jack. If you wanted to add some thoughts, that'd be great.
Yeah, of course. Thanks, MJ. So this slide, I'm looking at it, this slide 100% benefits nonprofits. Right? No one profit is the same as another. And this shows that there's a lot of different flavors out there for which nonprofits can choose from when they're looking to select an OCIO, because across the board, every single one of us does things a little differently. And it gives that optionality for nonprofits to pick and choose. So what we found through an RFP process, for example, an entity might go into the RFP process having one mindset that this is what they want. And then as they peruse these different options, they might change their minds throughout that process and go with whether it be an asset manager versus a boutique. So everybody can do it different. And I think one thing that's important is some might specialize laser focused on one kind of aspect, and then others might be able to provide different services, whether it be also being able to manage plan giving assets or providing custody in the house and things of that sort. So when you're going through the process of trying to determine what type of solution provider you want, you should really think about it holistically in terms of, do we just want it for this one aspect? Or do we want to try to see what else a provider might be able to provide us to help us fulfill our mission at the end of the day?
Yeah, absolutely. I find in the work I've done over the years that it's some of those non-investment services that really can distinguish a provider and make a difference in a partnership. For a community foundation, for example, some of the donor support, or for a higher education institution, working with students in some capacity. I think that's a little bit speaking to the OCIO 2.0, Bernie, that I know that Bank of America has talked about in the past. Any thoughts on that?
Yeah, look, we've seen this industry evolve quite rapidly since the financial crisis. And I would say what we're witnessing is more demand coming from clients that are looking for their OCIO provider to operate very much like they're an extension of their staff as an external investment office, but looking for that the holistic partnership that can sit on their side of the table within their organization to holistically look at their business and help them solve. So I think being a discretionary manager, so across the solution providers are here, there's a lot of great ways in which you can implement and help with that implementation. The OCIO 2.0 model, what we're claiming is where the industry is evolving to, is really stepping in and take a look at an organization and saying, okay, if you all have opportunities to dial up or dial down the levers that you have available to you across your business. And it might be starting with your strategic plan. It might be thinking about how do we get the board to become more develop a culture of giving? How do we think about different revenue streams? How do we think about ways to be more efficient and save costs? Do we have the right gift acceptance policies to accept the big gift that we've turned down before because we just didn't understand how we could take it in? There's a lot of challenges that organizations are facing. And I think if a provider can come in, if you had your own CIO and your own investment office, they'd be sitting in on your budget discussions. They'd be involved with what you're doing with your strategic plan. So if you can be a provider now that comes in and can bring the resources to help them solve some of those critical issues, help them with their strategic planning, help them think through what they're doing on their development side. Are they prepared to go out to do a capital campaign? What are the right things we should be having in place? Do you have the right gift acceptance policies, risk policies? So if what we're doing today for a lot of our clients is we have a dedicated consulting practice that comes in and it envelopes around the client so that we can actually help on those issues. Why is that important? At the end of the day, if we're going to wring the endowment or the foundation, squeeze as much as we can to get to what do we call it, maybe an 8% total return taken into consideration, spending, inflation, and cost of delivery of those services, that's a big challenge. And if you can try to improve the bottom line and reduce the cost structure so that you can take pressure off your endowment and foundation, then when you're building a portfolio, when you're looking to execute and implement, it's much more intentionally designed. And I think that's the next leg of where the evolution goes in the industry, is to be more of a provider. The providers are now coming in and bringing additional service to be that sort of OCIO 2.0.
Yeah, I found that kind of holistic total enterprise approach when you're working with a client really benefits across the board. You really do need to understand in the beginning of the partnership, what are all those levers that are affecting the success of the organization and how the investment portfolio might play a part of that. For example, in the higher ed space, we know we've got a lot of credit ratings. We've got different financial health measurements that when you look at the investment portfolio, some of those unrestricted assets can affect the financial health of the organization, debt covenants, if in fact we have a bad market. So stress testing those scenarios before you build an asset allocation, for example, helps you understand an even more complex degree of risk when you look at the organization holistically. So I think it's, to your point, Jack, it's really benefited nonprofits across the board as OCIOs have grown and evolved. I think that the implementation of whether it's a model portfolio or a custom portfolio is almost secondary to really understanding the client, because the investment piece of that can be justified in a lot of different ways. And as long as it's a fit for your organization, then the real important part is making sure that your provider is looking at you holistically and really understanding everything. Even within different segments, whether it's a community foundation that has multiple pools or one pool or wants to be more aggressive or more conservative, there's just so many different slices to this pizza.
Yeah. And I would say, picking up on what Teresa was commenting earlier, just around what might be important to a private foundation and their grant giving, and are there services and things that you can provide to someone to help them and assist them think through it? If they want to implement certain lenses they're going to look through on the ESG front. Not everybody does it, but there's a lot that really focus and can be specialized. And especially when it comes to, say, retirement or DB plans, there are certain providers out there that's their core focus, and they'll have a lot of additional services. So I do think that the industry is continuing to evolve, but the sort of way in which how they're building their business to serve their clients' needs are becoming much more specialized, for sure.
Yeah, and I think that we didn't really touch on this earlier, but the aspect of the OCIO also providing education to their clients, whether it be investment education around a specific topic, fiduciary training, all of that is also a critical part of this evolution of OCIO. So I think that across the board, again, nonprofits are benefiting from the evolution of the providers.
Add that foundations have volunteer board members, and oftentimes there's a lot of turnover in members of the board and members of the finance committee. So I think having a partner that can provide like ongoing education, it's not a one and done deal, because you could have a whole crop of new trustees the following fiscal year coming into it. So having that partner in education, I think, is critical.
There's a lot of stakeholders at different organizations. So it's different for Teresa versus Mark, right? Mark mentions the fact that there's students, and students can be educated as well. With all that's going on in the world, it's important to understand what a portfolio might actually be made up of. So educating those students, having the ability to do so, could be of value.
We're really recognizing that the selection process, the insight that's coming from the same report, was completed with a survey similar to the first one, where we looked at investment consultants with OCIO and asset managers with OCIO. And we asked them, what are the top two factors driving OCIO mandates? And without a doubt, the two top reasons, regardless of what type of organization, were a previous relationship with the client and deep experience with investors in that segment. So again, going back to really knowing your client, having deep experience and expertise in similar types of clients. It was a little bit different, a little bit reverse. Investment consultants with OCIO felt that relationship experience maybe weighed in a little bit more than asset managers thought, and vice versa. I want to also bring out that as we've evolved as an industry, the older criteria that seem to be the most important, like fees and performance, are further down on the list here. It's really more, again, about holistically understanding your client and having that cultural fit, that trust factor, because in essence, this is really a partnership. These are usually long-standing relationships. We don't want to make these changes very often, somewhat in marriage, right? You want to make sure that you're really selecting the right partner. As long as there's not too much turnover, that usually works out pretty well. I would also note that risk management, which is something I've always been passionate about, and technology capabilities weren't that big of a driving factor. So again, this is coming from the perspective of the provider and what they've experienced as they've tried to earn more mandates. But I would love to hear some thoughts from the nonprofit side of the table around these same types of criteria and what you think is really driving a selection process. I think we're going to start with Teresa on this one.
Yeah, great. I found this really interesting, especially because the Presser Foundation is probably poised to make a change in the structure. So it forced me to go down a path to think about those things that would be important to the foundation. Where my mind first went was that we don't have a mission that is related to the UN Sustainable Development Goals, right? We have a mission that is all about music and access to music and providing music education and presenting music. So when we think about our investment portfolio and aligning it with mission, because that's one of the major drivers to change our structure, things that I would look for in an investment management firm or an OCIO would be place. Where are they located? Because geography is a big consideration for us. We're very much focused on the greater Philadelphia area. And if we can take a portion of our portfolio and invest in the infrastructure to improve the greater Philadelphia area that benefits like all citizens of Philadelphia, that is something that I'm interested in. I'm also interested in information on how portfolio management teams are comprised. Who makes up the portfolio management teams from a diversity perspective, but not just gender, not maybe age, cultural diversity, racial diversity, et cetera. There's so much research out there that says diverse investment management teams, portfolio management teams just perform better. The other thing that I'm interested in is experience working with other foundations of similar size around mission alignment and what does that look like. And so many of my peers are touting that they're 100% mission aligned. And that could be a combination of ESG funds, that could be a combination of screening, that could be direct investments, that could be setting up a loan portfolio to your grantees. But I would be looking for a partner that can work with us and think about all of our assets and how we put all of our assets to work. And then obviously fees and returns. And I don't think you could ignore that. If we want to, the Presser Foundation documents are written that we are not a spend down foundation. So we exist in perpetuity. Because we exist in perpetuity, we do have to think about the investment returns that we're achieving. And those investment returns would support our mission work, our grant making work, and sustain us for the future. It's a different story when you're talking to foundations that are spending down, and they're less probably concerned about return and more concerned about putting their dollars to work towards their mission.
Now, you have a really great story I'd love to repeat about ways that the foundation's been able to implement some of that impact on their own through their grant making. And in particular, I'm thinking about one of the music venues in Philadelphia where we had a multi-year grant. I'll let you take it from there. You're much more close to that.
And just a little bit of background, I'm not like your typical executive director. I actually came from the investment management space and wound up in philanthropy and wound up in foundation management. But I'm a big part of the impact investing community here in Philadelphia. And because I had those connections to the investment or to the impact investment community, the Presser Foundation has an area of grant making that is providing capital support. So support for grants for building projects, large renovations, several hundred thousands of dollars over multiple years. For larger organizations, they can handle multi-year contributions towards large capital projects. But for smaller organizations, and in this case, it was a music venue that was shut down during COVID, and they wanted to take advantage of their doors being closed to make some much needed renovations to their space, but they only had a short window of time to do that. The Presser Foundation ended up giving them a 3-year grant of several $100,000 to do this work, but they needed, again, to do the work in a short period of time and didn't necessarily have the funds or they were not in the position to take on any more debt to finance the capital renovations. So I made a connection with the impact investing community that 2 people ended up stepping up and making a bridge loan backed by the fact that the Presser Foundation has a long history of making good on our payments for our pledged commitments. So they ended up giving a % bridge loan to this music venue. So they were able to get the work done in a short period of time. And then as the Presser Foundation paid the grant over the next 2 years, they were able to pay.
Yeah. And I brought that up really because, again, going back to the idea that it's a partnership and understanding how efficient your client is from the provider perspective is just as important as understanding how efficient the provider is in implementing. So it's really very much goes back to working together to find solutions to make it work for your grantees, for your organization, et cetera. Mark, I want to give you a few minutes to talk about your experience with this. You've recently gone through an RFI, you've been through the RFP process. What are your thoughts around what really drives the selection at the end of the day?
Yeah, thanks. And thanks, Teresa, for that good background too. I have a chance to meet with providers. And one of the things that I spend a lot of time on, and I have to say, to be in the space right now, it is ultra competitive. And I think that it's just a challenge. And I keep challenging folks that I talk to about what is it that really differentiates you, and really focus so much on that. Because oftentimes as we hear and we listen, and we did our last real true RFP about 5 years ago, but it's so hard to, again, differentiate that, because again, I think everybody likes to lead with fees and lead with track record and lead with, hey, we manage XYZ billions of dollars. And that's all fine and good. But what we found 5 years ago is what was the differentiator for us, and what we really focused on was it was an ESG type solution. We were really needing something that we could bring into the portfolio that would provide some reduced exposure in the fossil fuel area, but also retain returns and come in at the same fee. And that became really truly the deciding component of our decision. And we ended up changing providers because somebody came in with that great option and that great solution. And so, what's number 3 here on the list for us was number 1 5 years ago. I would say today, I think it's changed, and I think it's moving even post-COVID now. We've just seen a change and a difference. But that idea of, as Teresa said, sense of place, does somebody understand where we are and why where we are it matters? But also that experience with other investors in the segment becomes more and more important, I think. And We maybe lost a little bit of that when we did it last time. And yes, we just did an RI, which was just more to get a sense of the market, and it was very limited, and it served its purpose well. But I think that it's interesting how these things change. But again, my challenge is to try to figure out what the differentiator is. I would say also, though, what surprises me is the technology piece of that. And that for us 5 years ago actually was something that we focused our attention on, because I think it does matter. I think having good reporting and the ability to go in and customize and do some of that stuff really does matter. And I think we short sell that and maybe don't help clients like us really realize that there is a difference, and someone that really can come in with a great technological solution that can be one of the differentiators that might make a difference. So I wouldn't undersell that or ignore it. I do think that's still got some real value to clients like us. And I would also say training, like you said, to you, 100% great training is good, because yes, we're rotating people as well.
Yeah, that certainly is keeping the provider side on their toes and evolving. I agree completely on the reporting, the risk analytics, that as you become more comfortable working with an OCIO partner, the more detail that they can bring to the table to help you with your decisions is only going to benefit, again, the whole party. Bernie, thoughts on your experience around this? I know you've got lots of experience here.
Yeah, we typically do anywhere between 250 to over 300 RFPs a year. So we see the volume. And with every pursuit, we usually go through a process at the end that does a sort of a win-loss analysis of our engagement with the client to better understand, because we want to evolve. We want to continue to serve our clients and improve our services and figure out, so if we didn't win, why? What was the reason why we didn't receive the mandate? And Teresa, I put up those few things Mark and Teresa said I think are really relevant. When it comes to performance and fees, that's table stakes to get to the table, in my opinion. It's not so much as did you have lights out performance. It's got to be relevant to the client itself, because each are going to have their own risk tolerance, their own liquidity requirements. When you look at a lot of the benchmark surveys like the Nakubo study, everyone loves to see how are they competing against their peers, and what about the reach group, and how come I can't have this performance or this return? But everybody's different. Everyone's uniquely different. And so how well can they demonstrate their performance over periods of time relative to all their types of clients and their specific benchmarks and their specific liquidity requirements? So the organizations that I think can prove that to them is the way you have to look at it. And it's not easy, I think, for a lot of organizations to decipher how do you stack up performance from one provider to the next. It's a little bit complex. I'd also say when it comes to fees, that's another area where it gets to be a little complex. So you can look at a provider that can give you a very cheap advisory fee for the business of what they're going to do as an OCIO for you. But then when you really can peel the onion layer back, you'll start to see they may have some proprietary product in there that has underlying asset management fees that are built within it. They might have their own hedge fund or private capital fund structure or multi-manager structure. They could have fees embedded into that. And they might not put their advisory fee over it to avoid conflicts of interest, but is that being fully disclosed? What about custody? Those two areas within fees and performance tend to be table stakes to get folks to the table. But again, I'd say typical for a lot of times for organizations to decipher that and do a fair comparison to everybody. So I always just encourage folks to make sure that you look really at an apples to apples comparison when it comes to fees and performance. But I think the biggest area where we see focus from clients' perspective is fit becomes the biggest thing that we hear back. And I think fit, when you unpack fit, what does that mean? How did an organization come in to really understand the needs of the organization? Did they come in and really present a solution that's really specific to them with their issues, what they're trying to overcome? Also, I think it's that specialty practice, right? So if you're someone who's focused on the foundation space or grant giving, or someone that can come in and really has an experience of being able to deliver the performance when it comes to impact investing or sustainable investing. We've been doing this for a very long time. And I think early on, when folks were trying to mission align their investing, you were willing to sacrifice return for perhaps an impact. That's not the case anymore. You can still be able to have a return that sometimes outperforms even regular managers with no restrictions and be able to be mission aligned. And so I think the ability for organizations to come in, it's less about fees and it becomes more about fit and trying to find the right provider. Teresa made a great point. Are you local to us? Can you help us with thinking about the community where we want to make an impact? Are you someone that's going to bring us the right extra resources? We talked about that OCIO 2.0 model. how would that insert itself as an extension to our staff to help us as we tackle some of the strategic needs initiatives? I think that's where a lot of the decision making eventually comes down to.
Jack, I'd love to get your thoughts. And one thing that we didn't talk about that just came into my mind as we were discussing this is the front end of this process. So, Bernie, you mentioned getting to the table, you need to have X and Y, and that cultural fit and personnel are often the driving factor in your experience. But how often do providers have an opportunity to really work with a particular nonprofit before they get to this stage? And how much does that matter? And any other thoughts that you want to add from your experience, Jack, I would love to hear.
Yeah, no, that's great. That's a good segue into what I want to talk about. So not often enough. The RFP process is a lot of work for everybody involved, more so on the nonprofit than really on our perspective. It is, and to go a little deeper on Bernie's point, to me, it's people and service. Investments, fees, it's harder and harder to differentiate between one provider or another these days. And coming from the fourth largest asset manager in the world, I don't want to say that investment return isn't important. And maybe people at my organization might get upset for me saying that. But I do think it's harder to differentiate, and it's people and service. And that doesn't necessarily show up in here. And maybe more insinuated in the previous relationship type section. But if you're going to hire a CIO, you're probably going to hire somebody that you like and you get along with. And it should be no different for hiring an OCIO, is that it's the people and the service that they provide, because you are going to be dealing with them on a pretty frequent basis. So one thing that we've seen more recently, which is interesting and that we have enjoyed, is you go to RFP, there's a dozen providers that an organization will send it out to. Typically, you do look at fees and performance first to quell that down to a smaller list. Historically, I think people just jump right into a final situation. The top three might be different managers in terms of the slide we saw before, different types of managers. But what we've been seeing more recently is a semifinals situation, whereby you have a Zoom call like this, and COVID was a very bad thing, but obviously there's a silver lining to be able to doing things like this, where you can, to some certain degree, get a feel for the people that you might be dealing with. So you can open that up to more folks and be able to say, okay, their fees may have been a little high and we would have cut them out, but I really like these people and it could be a good fit. Let's move them on in the process, see if we can work with them on the issues that we may have put them out of the process earlier on. I think that's a big focus that it's hard to do because there are so many providers and it is a lot of work, but it is key. And we mentioned in the past that you shouldn't be rolling over those providers frequently because of how challenging this process can be. So understanding who you're dealing with on day one and how you get along with them is very important.
Yeah, I've found too that when you have that benefit of being able to have a conversation before you get to that final stage, it just makes that process that much more relevant. And I'll also add, for someone who like you and Bernie have probably been in hundreds of finals, having enough time at the finals is also a really critical part in making sure we understand.
Very much.
It's a long road to get there, and it's really critical.
Yeah, MJ, you make a great point, which is, as organizations are maybe listening here, how often, Jack, you've had this experience, you come in, you got 30 minutes to present. I don't know how you're going to really engage and really get a feel for an organization, 30 minutes to cover what you need, and they're on to the next provider. That is just a flawed process. I think you should really dedicate, to your point, MJ, dedicate more time to the folks that you're really going to consider interviewing to hire. Give them appropriate time. Really get into the issues. Let them talk, get a feel what it's like to work with them, instead of just coming and doing canned presentations for 20 minutes, 10 minutes of questions. And I'd also say too, that, and Jack brought this up too, it's getting the engagement process started earlier to get to know these organizations, the providers that are out there. As we've just put the list up before, there's several different types. Spend the time educating your committee and your board as to the different types of providers out there, and then decide, these are the types we want to work with. If it's boutiques, because there's something about a boutique that they like, that might be what you're focusing on. But if you're just going to send it out to 12 to 15 across the entire service provider spectrum, I think what you're going to do is you're going to confuse yourself in the decision-making process. It's better to figure out what's the right type of provider and then spend the quality time to go through, really understand the differences between those providers and give the time necessary to make the right decision.
It's a long process from the beginning to the end. I do need to wrap up, but I do want to thank our guest speakers, Teresa and Mark, for sharing your insights that you've learned at both your organizations and in your wealth of experience. And also thank our Institute members, Bernie and Jack, for their candor and contributions. But thank you all very much for joining us tonight. It's been a great discussion.
Chestnut Advisory Group is a boutique, practitioner-led management consulting firm dedicated to asset managers and investment solutions providers. In addition to the Chestnut Solutions Institute, our advisory practice areas include distribution strategy, M&A support, go-to-market, and implementation and coaching services. This podcast is owned and produced by the Chestnut Solutions Institute. If you like this content and would like to access more insights, webinars, and podcasts, please check out our website, chestnutadvisory.com.